Hello, everyone, and welcome to Teachly University. And in this lecture, titled Investing versus Speculation, we're going to discuss these two terms and really how, in fact, even though they typically have very different definitions, how they, in fact, could be used to complement one another when it comes to making investment decisions. And as usual, I want to start with a quote, and this is from Benjamin Graham, who said that investing is a unique kind of casino, one where you cannot lose in the end, so as long as you play only by the rules that put the odds squarely in your favor. And investing really has become increasingly popular, especially with the emergence of retail traders and investors who have entered the market. And we're seeing now how the term investing is used quite often to describe someone who purchased a financial asset, and how the term speculation is more often used to describe like gambling like or reckless behavior in the financial markets. And when it comes to the financial markets, whether it's real estate or the stock market or the cryptocurrency market, it is made up of buyers and sellers, and or really of human interaction where there's a level of unpredictability and risk involved with entering these markets. And of course, there is plenty of room or unlimited opportunity to make profit, but there's just as much opportunity or risk for that matter to lose money. And we see this all the time where in these type of markets, regardless of what they are, there will be winners and there will be losers. But regardless of whether they're winners and losers, the term investor is often used to describe someone who purchases financial assets or any sort of asset in the financial markets, whether it's stocks, bonds, real estate, etc. And the term investor, which this definition comes from the Oxford Dictionary, describes a person or organization that puts money into financial plans, property, etc., with the expectation of achieving a profit. So this is, I think, a very general or broad definition of an investor. When we think of an investor, we think of conservatism in terms of being prudent, doing our homework, being conservative with our investment decisions, not taking on a lot of risk. Or we think of people like Warren Buffett, for example, who's become to epitomize what an investor is, considering Buffett's one of the greatest investors of all time. Now, when it comes to the term speculator, again coming from the Oxford Dictionary, a speculator is a person who invests in stocks, property, or other ventures in the hope of making a profit by exploiting small changes in markets to make money. So there's, in at least this part of the definition of speculator, we can see that there are parallels or similarities between an investor and a speculator because, at least according to definitions, they both want to make money. Both of these parties want to make money in the financial markets, which makes sense. But then here's the part of the definition of a speculator that is more commonly used, especially in the financial media, where a speculator is a person who forms a theory or conjecture about a subject without firm evidence. And we see the term speculator often used to describe gambling-like behavior, especially in today's current market with all the volatility we see in cryptocurrency and the Reddit traders. And really this sort of euphoric sort of behavior where people are making very irrational decisions when it comes to money and their investment or their financial decisions when purchasing assets in these markets, and thus it's creating volatility that can create opportunity or risk. But regardless, this is the common definition of a speculator, is a person who just purchases an asset without any sort of calculation or theory as to why they purchased that asset. And there's actually an article that I found from the Wall Street Journal that I want to use briefly here that I think really discusses how the term investor is used quite often, or really used very liberally, especially in the financial press. And the article was written by Jason Sweg, and the title is "You Can't Invest Without Trading, You Can Trade Without Investing." And there's an excerpt from that article who says, "An investor relies on internal sources of return, earnings, income, growth, and the value of assets. A speculator counts on external sources of return, primarily whether somebody else will pay more regardless of fundamental value." So there's some truth here to this, because obviously an investor, and we can think of like a value investor, for example, who likes to purchase stocks that are undervalued or for like 50 cents for the dollar. They look at financial statements, they look at earnings, income growth, earnings per share growth, etc. Whereas a speculator looks at external sources, or they look at market forces, or they look at price, for example, or price action. If they look to see if a stock is breaking out into new highs, if there's the beginning of a new trend. And speculators look for underlying trends in the market, and they take advantage of those trends when making or deciding to make a decision to purchase an asset or not. But what Jason argues is that the term investor is used very loosely to describe someone who purchases an asset in the stock market. And I think he's right about that, because if you're somebody who just decides to purchase Bitcoin on the whim without any sort of calculation behind it or reasons behind it, or maybe if you purchase shares of a stock or a futures contract or whatever that may be, if you do it with running on raw emotion without any sort of system in place where you can know when to get in and when to get out of a particular position, that's not investing. That's something else. You can argue that's gambling, or irrational behavior perhaps, or you're just sort of pretty much just taking a wild guess as to the movement of that particular asset or where it's going to go. So, but speculation, I think, gets a bad rap, and I've said this in several of my lectures. I think the term speculation really is not defined correctly, and I want to borrow the proper definition of speculation from Dixon G. Watts in his book "Speculation is a Fine Art and Thoughts on Life." It's more of a treatise for that matter. But he says that, is there any difference between speculation and gambling? The terms are often used interchangeably, but speculation presupposes intellectual effort. Gambling, blind chance. Accurately to define the two is difficult. All definitions are difficult. Wit and humor, for instance, can be defined, but notwithstanding the most subtle distinction, wit and humor blend, run into each other. This is true of speculation and gambling. The former has some of the elements of chance, the latter some of the elements of reason. We define as best we can. Speculation is a venture based upon calculation. Gambling is a venture without calculation. The law makes this distinction. It sustains speculation and condemns gambling. So what Watts is talking about here is that speculation is not that you're being risky or reckless. In fact, you are investing. You are using calculation when it comes to making your decisions, but you also acknowledge that there is chance involved with your decisions, and that there is the risk of failure or losing money. And there's always risk, no matter how conservative or passive your investment strategy may be. There's always the element of risk or the loss of capital. That risk is always there. And when it comes to gambling, you're doing it without any sort of calculation. You're throwing risk to the wind and you're just going for it. You're taking a gamble without considering your options of knowing when to get in and when to get out. And the problem is with these definitions, and the thing is, there's a lot of words in our vocabulary, especially in the financial industry or in the financial markets, that can be very subtle in their distinction, such as investing and speculation. Though at face value there seems to be a difference, I would argue that in fact they're really one and the same to some degree. They complement one another. When you invest, you are speculating. And when you speculate, you are investing. At least with these definitions that the Mr. Watts provides. And he further adds in his treatise, it is better to average up than to average down. This opinion is contrary to the one commonly held and acted upon, it being the practice to buy, and on decline to buy more. This reduces the average. Probably 4 times out of 5, this method will result in striking a reaction in the market that will prevent loss. But the 5th time, meaning with a permanently declining market, the operator loses his head and closes out, making a heavy loss, a loss so great as to bring complete demoralization, often ruin. But buying at first moderately, and as the market advances, adding slowly and cautiously to the line. This is a way of speculating that requires great care and watchfulness, again, calculation. For the market will often, probably 4 times out of 5, react to the point of average. Here lies the danger. Failure to close out at the point of average destroys the safety of the whole operation. Occasionally, a permanently advancing market is met with and a big profit secured. So what is Watts talking about here? Well, what he's talking about is the common held, really the common wisdom, held wisdom in the financial markets. For example, that if a stock goes down, it's just a perfect buying opportunity. You're buying the dip. That's a common term that's used. You're buying the dip and hoping that it goes back up. And yes, this method can work. I'm not saying that there's no value to it. The problem is when you buy an asset that goes down in value, it's going down in value for a reason. And there's a real risk that if it goes down, it can continue to do so. And what happens is that by purchasing an asset when it's declined in price significantly, you put yourself at risk for greater losses, and that could be demoralizing. It's not just the financial capital you're putting at risk, but it's also the psychological risk that you're putting yourself in. It could be devastating for your self-esteem, and it can actually impact your decisions. So what he's arguing here is rather than buying on the dip or averaging down, you purchase when the market is advancing. You're following trends. You're doing it with great care and watchfulness. You're taking many things into consideration. And you know when to get into a position as the market advances, but you also know when to get out before you incur further losses so you can protect your capital. Speculation is not reckless. In fact, it's quite the opposite. You're using calculation and great care and watchfulness. You're practicing your due diligence and you're protecting your money. I think it was Warren Buffett has said rule number 1 is don't lose your money. Rule number 2 is follow rule number 1. Don't lose your money. That's really the most important thing here. And when in this chart here, this was taken in 2020, I think we all know what happened in the stock chart here when the market tanked during the beginning of the coronavirus pandemic. Okay, it was one of the largest drops in U.S. stock market history. And like many investors, if you were in the markets, you probably took a significant hit. Trillions of dollars in wealth was wiped out. And if you bought and held without any sort of system in place to get out, that in fact is gambling. If you're just buying and holding, hope that it goes back up again, well, you're putting yourself at significant risk. I mean, just think about it. If you're, say you purchase a stock and it went down by 30%, you would have to basically earn 60% just to at least break even from your original investment. And again, it's psychologically demoralizing. I think a lot of people during this period in history were demoralized when they saw their portfolios hit rock bottom as a result of the coronavirus pandemic. So investing and speculation go hand in hand, or in order to maximize profit, it requires using proper calculation that guides our investing decisions as far as when to purchase an asset and when to sell. Speculation means looking at our investment decisions as maximizing profits and cutting our losses when the risk is too great. We want to expose ourselves to massive opportunity, to profits, while minimizing our risks to financial loss. And when we have that system in place, and there's a lot of ways to be able to make money in the financial markets, no matter what they are, it requires having a system in place so that you can maximize profits and minimize losses. It's common sense. But investing and speculation go hand in hand. They need one another. Because when you invest, you are speculating. No matter how conservative you are, no matter how diversified your portfolio is, there is risk. You are, in a way, speculating. And it's important that you protect yourself from market volatility, which is natural to occur. And risk is a necessary ingredient. when it comes to making financial profits. Without risk, there is no reward. I've said this on several occasions in several of my lectures. Without risk, there is no reward. And risk is a necessary ingredient. But when you know how to manage risk and use it to your advantage, tremendous opportunities can come your way, no matter what market you are in. But it does require calculation and knowing how to manage your risk so that you can take advantage of these opportunities that may present themselves.